One of the stocks that it is talked about a lot lately is Bristol Myers Squibb, and it has been an interesting ride this year, with a lot of ups and downs resulting in a minus 7% year to date. And the company announced pretty solid earnings, where they beat the analysis estimations, with quite some margin, and the stock tanked about 11% after these earnings. And we all know why most people like BMY stock. It's the juicy 4.9% dividend yield. But what about that payout ratio? Is this a dividend yield trap or is this number diluting? Let's find out by diving into the earnings. Total revenue was reported at 12.12 billion, up from 11.2 billion, resulting in a 9% increase year over year, which is really impressive if you ask me. However, gross margin decreased from 74.4 to 73.2%, so definitely keep your eye on that number. Expenses increased, and because all of this, the diluted EPS decreased from 99 cents to $0.83 on a GAAP basis. On a non-GAAP basis, things look pretty different. The earnings per share are covering the dividends very easily. So the 170% we saw earlier isn't fully correct here. On a GAAP basis, this number is at 72%, which is still a bit on the higher side, but it's already a big difference with 172%. A few interesting things I noticed in the strategic approach is that they keep looking to diversify their portfolio and strengthen the long-term outlook. So they are really focusing on growing. Another interesting thing is that they plan to pay down 10 billion in debt over the next 2 years and remain committed to the dividends. And the growth I just mentioned is really important for this company. The growth portfolio is increasing 18% year over year, which is looking really good. The legacy portfolio is only at 2% growth year over year. For the upcoming period, it is expected that revenue will increase at the upper end of the low single-digit range, which is revisit from their last guidance range. It's the same with the gross margin. It is expected to increase again. It is also expected that expenses are not changing and that EPS will be in a range of 60 to 90 cents instead of 40 to 70. So this looks really good to me. And now that we know a bit more about the company, it's time to check the fundamentals. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Bristol Myers Squibb is a 99 billion market cap company. PE ratio isn't shown because of the most recent reported net loss. However, if things go according to plan, the PE ratio will be back again in the upcoming quarters. Later in this video, I will show you my 3 price targets for BMY stock, so make sure to watch until the end, since these price targets might surprise you. Revenue is at 45 billion, and in this graph we see that revenue went up in the long run. Not always steady and consistent. Also, most recently, revenue is finally increasing again after a period of decreases. The margins don't look any good. We see decreases on gross margins, and the other two are also decreasing even to a negative number. However, if we check the earnings report, we see that operating margin is actually reported at 33.7% in the most recent quarter. So this isn't processed in the graph yet. For the EPS, it is pretty much the same story. So this doesn't worry me too much, since the numbers are increasing again on a quarterly basis. And also, the outlook is looking pretty decent. Analysts expect that EPS will recover back to $7 in 2025. After that, they expect EPS to increase again, which is quite interesting. For the revenue, analysts expect around 3% growth in 2024. However, in the year after 2024, it is expected to see a revenue decrease. Again, Very interesting since, in their own outlook, they were expecting much higher revenues. Also, with the new focus on growth portfolios. Return on assets is sitting at a minus 6.88%, which is a really bad number. Return on equity doesn't look good either. But the most important number, return on invested capital, is sitting at 10%, which is a great number. It is also higher versus the 5-year average, which is a good thing. Current ratio is at 1.16, which is a great number. To me, this looks pretty good. Over the years, it is decreasing, which is actually a good thing. Right now, BMI has 54 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. BMI has almost 7 billion in total cash, so they can't pay down a big chunk of their debt. In the earnings presentation, we saw that they are planning to pay down at least 10 billion in debt in the coming 2 years, which is the silver lining here. So for now, it is not looking any good, but better times ahead. However, it is still very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends, and all other things. And here we see that free cash flow is going up in the long run. In 2020, we see a big increase due to COVID vaccines, and other than that, it is looking really steady and consistent. Shares outstanding are decreasing every time they increased after acquisitions and all of that, which is something that I really like. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the P/E ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 4.9%, which is a great number. Annual payout is at $2.4 and payout ratio is at 172%. And this number is a bit diluting here, since the reported EPS in the recent quarter was actually at $0.83, resulting in a 72% payout ratio. The 5-year growth rate is at almost 8%, which is a great number, also considering their yield and payout ratio. They increased the dividend for 7 years in a row, which is also nice. And if you take a look at these numbers, the dividends paid since 2014, we see that BMI did increase the dividends at a decent pace. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that payout ratio is going up big time, as mentioned multiple times now. This is because the numbers aren't fully updated yet. It is expected that in the coming quarters the number will decrease even further. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course, this is an estimation that can be highly impacted by results, but it gives you a rough indication. It's expected to increase at a similar rate versus previous years. And overall, these dividends look really good to me. But how about the historical returns? I decided to compare BMY stock with the overall market, in this case the S&P 500. Next to that I added Merck & Co and AbbVie. On the 5-year chart we see that BMI had by far the lowest return at only 22%. And keep in mind this is including dividends. The S&P 500 is sitting at 109%, and AbbVie managed to beat the S&P 500 with 263% return in total. On the 1-year chart things look pretty interesting, with BMI sitting at minus 17%, while AbbVie had the highest return with 36%. On the 6-month chart it is again BMI sitting at a negative number, minus 1% in total, so they are starting to recover here. Both the S&P 500 and AbbVie had the highest return again. On the 1-month chart it is finally BMI that is having the highest return here with almost 15%, beating the S&P 500 massively. Bottom line, BMI was beaten by the S&P 500 and competitors in the long run, but in the short run they really found some momentum. So could this be the perfect time to buy BMI stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 4, 6 and 8%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm putting in 4, 5, and 6. For the free cash flow margin, I'm putting in 25, 26, and 27. For the PE ratio and price to free cash flow, I'm putting in 6, 7, and 8. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. And right now, BMY stock is around $49. I hit analyze, and we see a lot of interesting numbers. And since the company is facing some issues with the recent earnings numbers, I'm not focusing on the multiple earnings value here, since I expect this number to recover in the upcoming quarters. We have a low price target of $51, we have a mid price target of $63, and we have a high price target of $78. And to me, the mid price target is the most justified here, meaning the stock is undervalued based on these numbers. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Bristol Myers Squibb is that it is an interesting company. Most fundamentals look pretty good, and the fact that they are focusing on growth and paying down debt comforts me a lot. I think people are finally seeing that BMI is recovering, and that they are doing everything they can to be back on track. Things like payout ratio and EPS might scare people away, which is in my opinion a bit diluting. It also means that there were a lot of buying opportunities. The dividend yield itself looks pretty interesting. It is high, it is growing, and also at a decent payout ratio historically. From a value point of view, things also look pretty interesting. I do think the stock is undervalued and I put them on my buy list. I'm currently not owning this stock, and I do want to expand my health sector, especially after I sold UNH recently. The question is if BMI stock is the best stock at these prices. So I'm also going to check other healthcare companies. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.